Hi, this is Paul from globaltradingsoftware.com, and this is a breakout trading tutorial. I'm using Forex, in this particular case, Euro GBP on the 10-minute. The range breakout trading indicator from xBrat is very, very simple in that it identifies the opening range, then gives it a bias, and basically you look where to trade. But also we have that bias depth heat map to give us that confirmation, and I want to talk about that especially today. But then also that behavior to manage the trade to maximize the profits, and understanding candle by candle what's happening with that behavior with the manager to stay in trades and not to panic, and then to get out and to maximize those profits. So Euro GBP today, pretty basic. We have the European gold pit open here at 8 a.m. European time, and then we have the London and European open of the stocks at 9 a.m. So we can define those ranges because this is where we find the catalyst for a lot of Forex move, because depending on where the DAX and the FTSE goes, depending on that gold pit open, where gold and the US dollar goes, will affect all of the Forex pairs, and we can actually define those opening ranges. We're using the 10-minute time frame because over time and testing and back testing, we've seen that 10 minutes on currencies is the optimal time frame for that opening range. We then look at the bias. So initially, when they get the European gold pit open, in this case here, the tag is colored in green. So we're looking for a breakout trade to the upside. The actual opening range is colored in green as well. So we are looking for a long. The only thing that puts me off here looking for a longer term trade is when we look down at the bias depth heat map. Only 1, 2, 3 out of 6 time frames the bias is bullish. The others are neutral, are yellow. So in this case, for me, it's just a quick scalp. So we get in two ticks, 2 pips above the range that's been defined, and then after 10 pips we make it risk free and we just take a quick scalp, okay? Because this is not got the juice according to the bias depth heat map to continue that trade. In a lot of cases I would say don't take it, wait for the London open, see what happens. In this case, the London open, it's a bigger range, there's more volatility during that opening range. The London tag is coloured in red, so we're only looking for shorts. The actual range is coloured in red, so the bias is bearish, so we're looking for a breakout to the downside. This time, all 6 time frames on the bias depth heat map are red. We have the confirmation we need that this thing's going to go. And it does. It breaks out, and this is the trade. It finds initial support, which always does. This is behavior. This is market behavior. We have a big move down and we have a pullback against the move. To maximize profits consistently, you need the manager to manage the trades, to help you manage the trades. So let's talk about the behavior of this move up against that initial trade that we've got, and understand why you would not have taken the trade out. Remember, that opening range again could be tested, but this time as resistance, which it did. When we get this rejection of these lows, this is a grey candle, so it has less volume than that previous candle, but also this dot underneath shows actually it's lower than average volume. So it's a lower than average volume rejection. If it was green and the dot was above, I'd be a little bit worried, okay? But at this time it's not. We get lower than average volume, low than average volume, then we get a full green candle on average volume. There's no dot above or below. So again, not panicking right now. One of the other things that we look at is this ribbon on the manager is still red, so we still should be short. We then get a higher than average volume red candle. So the red candle has more volume than the previous candle, and it's higher than average volume pushed out. We get a push back up again with higher than average volume, but it's grey, it's not green. So it's an up candle, but it has less volume than this previous big candle here. So it's going to run out of juice, and this is what it did on average volume here, average volume indecision doji, looking at resistance at this point, then starts to move back down. Higher than average volume, big red candle here. Tries to recover, not a chance. Grey candles, come back down again. Higher than average volume, red candle. Look how far are we away from this ribbon right now. The ribbon is getting wider. This bearish move is continuing and we should be in. We should not have panicked at this point because we can understand the behavior by using the manager. We're now coming back down. So where would our trailing stop be? Let's draw this in. So when we've had this first pivot here, our initial stop loss is a couple of pips above that the high of that London range when we go when we take the short. That's given. Okay. We then have this first move down. It moves back up and then pushes back down. As soon as it breaks this pivot here, for me, I want to go risk free. Okay. We then have a little push to look up, comes back down again. We go above this pivot. Remember, we've got to be reasonably conservative with this because we can flatten this trade at any time if we get a couple of green candles, consecutive green candles with higher than average volume. There's only one here and we call it a one candle wonder because that was followed by even more volume. It was red and it was higher than average volume to the downside. So we could see that two consecutive green candles with higher than average volume would be the time to get out and flatten, or indeed when this ribbon turns green. At this moment in time, we're pretty good. If we wanted to be aggressive right now, we could go above this small resistance that's being formed. But for me, I want to be conservative. The trade has no risk for me right now. My entry was up here. I've got a trading stop here. What I need to see, if I was going to go aggressive with a trading stop right here, I'd need to see this pivot broken at this point here. At this moment in time, we're most likely, I'm not saying I've not got a crystal ball, we may have a little pullback on lower than average volume and then it come back down again. Understanding that behavior is very, very critical, and the manager helps you do that. We got in the trade sensibly. We got the confirmation from the bias depth heat map. We're in the trade. Now it's down to the manager to help you manage the trade to maximize profits. We are risk free right now, so let's just give it a little room, let it work itself out. If we get two consecutive green candles with higher than average volume, we flatten. If the ribbon turns green, we flatten. If we push down below this pivot, I'm quite happy to move my trading stop just above all of this resistance right here. But right now, I just need to let it play out. And sometimes when we're trading, especially Forex traders, we can be a little bit too quick to get out. We need to allow the manager to take over those reins a little bit. And it's just, the manager is designed around my trading brain. I've been doing this for 20 years. The idea is that I don't panic when I get pulled back against the main trade if that volume tells me that, and the price action as well, that there's no need to panic, that it's just what we would call a normal behavioral thing within that Forex instrument. And as you can see here, it came back down again. But I can guarantee 80% of Forex traders would have panicked on this pullback and got out. They would not have been able to maximize those profits as we are doing right now. Hopefully that helps. Speak to you all really soon.